Welcome to IGO. That stands for In Good Order. This is the podcast for financial professionals looking to scale with confidence and clarity. Today, we're talking Roth conversions and tax efficiency in retirement with Tyler Randall from Stonewood Financial. Stonewood Financial, we've worked with a lot here at SMS Financial Solutions in the past. They provide simple, straightforward, and innovative technological reports and tools to help advisors better articulate the tax-efficient retirement conversation. I've said many times on this podcast, if you're selling safe money, if you're selling guaranteed income, that's fantastic. But what's going to be the true differentiator between you and the agent down the street? It's talking taxes. For that reason, we're going to talk to Tyler now. Listeners, there is going to be more visual elements to the episode today. So if you're listening on Spotify or Apple Podcasts, go check out the YouTube channel. I'll do my best to describe some of the charts and graphs that we'll look at with Tyler today. Tyler, how you doing?
Yeah, doing great. Hey, appreciate you having me.
Excellent. Well, we appreciate you being here, Tyler. So let's first talk high level. Taxes in retirement. Tax is a three-letter word that a lot of advisors are hesitant or even concerned about involving in their conversations as a complement to assets under management, annuities, life insurance, and long-term care. What do you find is the biggest objection from financial professionals to even start the conversation?
Yeah, I think a lot of times people are just a little bit overwhelmed by feeling like they need to be a tax professional to give good advice. And really, the idea of introducing Roth should be something that should be easy to do. And so I think having tools and resources that make it easy to introduce that conversation and open that conversation, it's helping advisors and agents lead to a ton of new business, because who doesn't want to save on taxes? I mean, it's a big deal. And I think there's a lot of components to it that the general public doesn't understand, and feels like if you're able to introduce some of these ideas and keep it simple, that you're really differentiating your practice and you're providing a tremendous amount of value to them that maybe their current advisor or where they're getting their advice from, maybe they're not doing it. They may be in the same boat that a lot of advisors are that say, hey, go see your CPA or your tax attorney or whoever it is. And I think if we can give you some tools and resources to introduce the ideas in a real simple fashion where it doesn't seem overwhelming, that it could be a big driver of new revenue for your business.
So that's one why. From a consumer perspective, or from an advisor communicating to a consumer, why is it that we're advocating for Roth conversions? The vast majority of mass affluent Americans, their assets, their nest eggs are what? Qualified. And what a lot of those folks don't understand is every single dollar and cent inside that qualified IRA, 403B, 457B, 401k, what have you, is entirely taxable. So for me, it's always, are taxes going to go up in the future? And that's what you refer to as legislative risk, correct?
Yes, and taxes coming up. There's actually a few components of it, but that's certainly just some. Whenever there's a permanent tax bill like we've just seen that has passed with the One Big Beautiful Bill, history tells us it's about 8 to 10 years before a new administration steps in and unwinds it and raises taxes. And those taxes have tended to go up somewhere around 30% historically. And so that is one component of it. But the other part of legislative risk, and we have a lot of marketing tools and resources to help you understand this, training tools to understand that. But the other part of it is, what if Congress just decides that they want to change the rules on a Roth IRA or any other tax-free? I think if you look back, Social Security wasn't always something that was supposed to be taxed. And then at some point in our, in the wisdom of the U.S. Congress, they decided, well, hey, if you're making enough money, we need to get a little bit of that money back. And so that's the legislative risk, is the fact that tax rates could change, new taxes could be introduced, they could change things to the format that we have today. We just don't know. And what we do know is, like you said, is that most people have all their money in a deferred account that has paid no taxes. And at some point, when they hit the required minimum distribution stage, they've got to take the money. And it's an RMD problem that looms for everyone. We can't defer these things forever. And it's going to be, what's the tax rate when you have to take RMD? And then what amount do you have to take out? And then how are those assets distributed when we die? It used to be we could stretch it out over a long period. Now it's 10 years. What if it's lump sum in the future? We just don't know. So all those things combine that legislative risk, which is the uncertainty that we don't know how that money is going to be taxed for us or for our families.
The tax code is certainly written in pencil. I mean, who would have thought that with the 2020 Secure Act, suddenly the efficiency of stretch IRAs would just be completely eliminated?
Gone. Right.
Can you repeat that fact? So every 8 to 10 years, through administrative changes in Washington, that can lead to taxes going up as much as 30%. Did I get that correct?
Yeah. So what we did is when the OBA, the One Big Beautiful Bill, passed, we just kind of looked back historically and said, let's look at future permanent tax changes. How long did they last? And then what was the increase? And they lasted somewhere between 8 to 10 years before a new administration came in or a new Congress came in and changed the rules and increased taxes. And so that's just a historical look. So, for example, when you get in and you're using some sort of forecasting to say 8 to 10 years from now, taxes could go up 20 to 30% is pretty historically accurate.
And with 1 in 4 65-year-olds living to the age of 90, I believe, and 1 in 10 living past the age of 95, that means for a 65-year-old right now, 10 years in, there's at least a 15 or even 20-year runway where they could be looking at significantly higher taxes.
Yes, lots of new presidents, lots of new Congresses, there's lots of legislative risk. And so that's what we're really trying to address, is how do we keep it simple for the advisor to create and open these conversations? And how do we keep it simple to present to the general public so they can understand it and make a decision? And a lot of times just helping them decide, is it right or not to consider a Roth conversion? And sometimes it's not. You're not better off. And that's good to know. What you've done is helped people understand that. But in a lot of cases, to diversify a portion of that qualified money, whether it's 10 or 20 or 30% or 40%, whatever the percentage is, and get it in a tax-free solely to diversify their tax situation in retirement, makes a lot of sense for people.
And I like that Stonewood approaches this, as do I, through tax efficiency, because there's other marketing programs and strategies that's all about completely tax-free. And if we can get to 100% tax-free in an efficient way, being cognizant of IRMAA, Social Security threshold taxes, long-term cap gains, that's great, right? But what I like about Stonewood is the analysis, and we'll get into that, really allows the advisor and the client to come to the best decision of what's really appropriate when you look at all the different variables.
Right.
So, and this is both a program that can help life insurance sales, annuity sales, assets under management.
I think all the above. Yeah. When you have that conversation, should I convert money to a tax-free? The landing place could be assets under management and just under a Roth wrapper. Could be an annuity under a Roth wrapper, or a lot of people are using bonus annuities to help offset some taxes. That could be a solution. Or we could introduce a life insurance sale. If it's certainly for the legacy assets, people that say, I accumulate all this qualified money, but I got plenty of income from Social Security and pensions or wherever it is. I'm really just going to defer this, take my RMDs and die with it, pass it on to the family. Those people should really be considering some sort of legacy planning that might include a life insurance as a sleeve of it.
And listeners, for those of you that are looking for just a 101 entry into Roth recharacterizations or Roth conversions, if this is already a little bit over your head and you're thinking, I know contributory Roth, but I don't understand how this works, reach out to me. I'll connect you with Tyler, because it's through Tyler and through these simple, straightforward reports that we're going to review in the preceding slides that I now feel very comfortable talking about Roth recharacterizations and Roth conversions, be it in annuity capacity, assets under management, or as a means of funding life insurance when appropriate. So another thing that I want to emphasize as to why I thought this would be such a valuable episode of IGO is ultimately we want growth-minded advisors to grow. And what I've seen, and I'd like to hear your perspective on this, the offices that introduce taxes in retirement see higher growth, more annuity sales, more life insurance, more AUM, more referability than the advisors or offices sitting on the sidelines because they're scared of the three-letter word that is tax.
Right. Yeah, I totally agree. And I think it's just, especially if you're listening to this and you're not someone that's talking tax or Roth conversion as an option, well, so is probably 90% of advisors and agents out there, because they're leaving it to somebody else. And that's why it's become a tremendous hot button and hot topic, because the advisors that are talking taxes are gathering assets from those that are not. And what, because if I'm having this conversation with a client, I can show them how to save $500,000 in taxes potentially and leave more legacy money to their family by doing some simple planning. My conversation is, hey, you can let your bank guy or whoever, wherever this money's at, leave it at your 401k. You can try to do this on your own, but they're probably going to mess it up. It does need some proper planning. If you move that money to me and we manage it, we'll make sure this is done right. And that's where stepping in and using some of our tools and resources to make sure it's done right, with our Roth done right, our legacy done right. It's very easy to open these conversations and then make sure that the plan is put in place in the most optimal way. And it's just giving you a conversation to gather more assets or to help even existing clients. And sometimes when you start talking this way, even existing clients where we think we have all their money, and I know that I was an advisor for a long time, I thought I had all this person's asset. Of course, they wouldn't work with anybody else, but they had 200,000 over at the bank, or they had some money at Ed Jones or someplace else. And all of a sudden I give them a concept where they're like, well, maybe I could grab this money and bring it over. And that's what we're trying to do, is open a conversation that allows us the opportunity to gather more assets. And that money can land in your assets under management or annuities or life. And you can see your revenue be driven just by opening up a lot of these conversations.
I think the stat was if a client has $3.2 million or more in assets, they're probably working with 3 or more brokers. What I love about taxes in retirement is if you are a broker and your client did really well during the longest bull market in history, being the last 10 to 12 years, good job. But if another broker advisor is talking taxes in retirement, that's going to be the differentiator, because now you can take all those gains and distribute them that much more efficiently. Love it. Awesome. Okay, let's we talk. That's the tactical. Why the Roth, right? Where does the Roth fit? And why I'm so bullish on these strategies as a mean of client acquisition, client retention, and growth. So with that in mind, Tyler, I know you brought some visuals for us today to see some of these reports.
Yeah, I think just like the general public, we've got to see the numbers. It's like, show me, and I think that's the part of it that we intentionally try to make the presentation of the idea very easy through our software. And we do it two kind of simple and easy. One is, we don't want you to have to spend hours of your time creating reports to do analysis like this. We want it to be able to be done in a few minutes. And that's what we've built. And then from a presentation standpoint, we want to be able to show people the reason why they should consider a Roth, and help them make a decision very quickly. And that's great, because if they make a decision to move forward, now we've got new assets and money in motion. And so simple from the creation standpoint, from the advisor and agent end of things, and then simple from a client end of things. So our first version of what we do is called total tax burden. This is the 101 Roth opener conversation. And we have marketing material and lead gen and all kinds of things on this. But it is very simple to create this report. We need an age, we need a dollar amount. You put in a return assumption and a tax forecast and a period of time to convert this, and you will get a report that basically says, hey, Mr. Client or Mr. Prospect, on your $500,000, if you keep deferring this to RMD and then die with it, here's where the IRS is going to tax you, $272,000 in taxes just on RMD. And that may be a shocking number for people. If you don't spend your required minimum distributions and you reinvest them, you're going to pay taxes on those earnings, and that could be up to $92,000. And at death, there's $331,000 of taxes that the beneficiaries will pay on the remaining balance. So the total is almost $700,000 on $500,000. If we do some proper planning over the next 5 years and reallocate this to a tax-free, and of course this could be a 7-year or 10-year or 3-year, whatever you want to do, you can plug that into the software. But the tax liability could be as low as $125,000. And when we show this to somebody and say, people can look at it and see that, okay, I might want to consider a Roth conversion if my tax savings is hundreds of thousands of dollars as this is. And this is like the easiest way to start and open a conversation. Just want to show you kind of where you're at if you keep doing what you're doing and what it could look like if we considered a Roth. And this is a great report. The limits of it is it does not show us any of the optimal pattern. Is 5 years the best? Is a 7-year conversion the best? Is a 3-year conversion the best? It doesn't take into account another big factor, which is the IRMAA fees, the income related to the monthly adjusted amounts. For people that have large qualified assets and are high income earners, they're getting surcharge and fees that go against their Medicare, and it reduces their Social Security income, and it can be very significant. So we want to consider, if I keep deferring this account, how am I impacted by those fees and charges? And those fees and charges continue to go up and increase historically. And the other thing is when do I break even? If I do pay this $125,000 in taxes, like in this example, and I walk out the door and I get hit by a bus, wouldn't I have been better off just leaving the money in a qualified account? And oftentimes it does take a period of time for the Roth to accumulate more. So we want to analyze all those things, and we want to keep it simple. So we created a program called Roth Done Right.
Real quickly,
yeah,
just that initial report, listeners, I call that the Moneymaker report because it's a great way to start the conversation before we get into what we call the hidden taxes in retirement, which I know you're getting to, Tyler. But that initial report can be so valuable in both educating consumers and educating clients on why you want to pay the voluntary taxes over the next year, 5 years, 10 years, because ultimately, even if you take the legacy component out and you don't care if your adult beneficiaries or adult children are going to have to pay a huge tax bill, you're still going to cumulatively pay, based on this report, more in taxes just on the RMDs alone.
Yep. And you said something that I really like. We do, through our training, we do a lot of it on how to introduce and kind of story sell this, but we call that keep the qualified account your optional taxes. And nobody wants to pay an optional tax. And the column on the right is your mandated taxes. This is the minimum amount of taxes we can get away with paying and get this money into a tax-free. So
optional versus, that's better than voluntary. Thanks, Tyler.
Yeah,
that's great.
yeah,
So
optional, because nobody wants to pay. And I think when you couch it like that, people are like, "Well, I don't want to pay an optional tax." Well, okay. Well, that means that we should probably have another meeting on this. And what we'll do in that meeting is you can close a lot of business with that last report.
Yeah.
Trust me, it's been done and continues to be done. But if you want to take kind of the next step, the 201 version is the Roth Done Right. We'll take into account taxes and the IRMAA fees for both clients that don't need this qualified asset to live on. We call those the RMD clients. They're going to defer to RMD and die with this thing and pass it on to their family. Or client or prospect number 2 that needs income. We call it a level income. They're going to take a withdrawal. When they retire, they're going to need all their qualified money, and they're going to take income out. And we're going to look and see if either of them should consider a Roth conversion. So This is a little bit more detailed. We do need income information, and we need to know their total qualified assets. And we have a fact finder for this, so it's easy to put this in front of it. But this is the inputs. We put this in, and it'll calculate an effective tax rate for the client based on their income and a standard deduction. And we can model whatever tax changes we want. We have some defaults that in the future, taxes move up a bit. We show the IRMAA fees increasing a bit, and we show the beneficiary inheriting this money, 30 years from now at a higher tax rate than they are today. So I think all pretty conservative estimates and realistic estimates. And for this, the advisor or the client with an advisor or an advisor with a client that needs income from their qualified account, and when they retire, they're going to start withdrawing money. We're showing $53,000 a year, and we can talk about how we get to that in a minute if you'd like. But the idea is that they will pay $440,000 in taxes over their lifetime just from taking those distributions out and living on them. They will also be assessed $147,000 of additional IRMAA fees because of this IRA income that they're taking. And that is directly being assessed. It's a monthly fee assessed to their Medicare that's reducing their Social Security income. And that can be pretty significant. Most of the time, most advisors and agents are not showing that to clients because it's complex, and we try to make that conversation pretty easy. Total is $587. So then the other client is the one that says, I don't need this money. I'm going to defer it as long as possible. I'm going to take my RMDs and pass this on. They will pay $655 in taxes, $165,000 of IRMAA fees, and a total of tax and IRMAA fees of over $800,000 on this $500,000. We're just evaluating this $500,000 piece of their qualified account. And so should either of them consider a Roth conversion, taxes could be reduced down to $140,000. The IRMAA fee reduction is, I think, equally important. There's $13,000 in IRMAA fees because we will have unwinded this qualified asset before those really start to accumulate and increase. And that can be significant because we have less fees. That means we create more Social Security income. And that is a big deal for a lot of your high income earners. So here's the total. We do a report that looks very simple like this. And again, easy to create the report and easy to present it so that somebody can see, should they consider a Roth conversion? And in this case, yes. And a lot of times it's this report right here that allows us to gather the assets, because if we're able to show a tax savings and an IRMAA fee reduction for your high net worth clients with high incomes, they're saying, hey, nobody's talked to me about this. You're the first person. And that's a differentiator when we're showing something like this. We do tons of training. We show you how to do this and talk about it and introduce it. But I think you can see the inputs are very simple, and it's pretty easy to present this. So you'll get a report, looks like this. You'll also get a break-even analysis. So we know that what age we need to live to in order for the Roth, if we were to drop dead at any of these ages, where is there more money left to the family? And if we just left the money in the IRA until about age 66, they're better off. There's more money that would go net to the family. But after that age, and it's different for everybody, some people it's out at 80 or 85 or 87, depending on how we structure this, but it'll show when the Roth does start to accumulate more.
I have an
Yep.
opinion on the break-even analysis that I'd like, or propose you a thesis on what you think of this, because I've seen tools that do this, and I like this, right, for some clients. Other clients, much like a retiree sitting on a 3% mortgage, it might not make fiscal sense for them to pay it off right now, but psychologically it makes them feel better. So if psychologically they know that their retirement income is going from taxable to tax-free, I think break even is great. But sometimes, I mean, what's so attractive about this story is, hey, we're going to divorce the IRS from your IRA, full stop, and you're going to get off the tax train. But I think the break even is great. But do you also, or do you see that sometimes clients just psychologically, yeah, I'd love to pay my mandated tax now and know that I'm never going to have to deal with this on a portion of my portfolio again?
Yeah, I totally agree. If they have assets and it's not a big deal for them to pay the taxes outside of the qualified account, terrific. I think that probably works very well for them. there is a lot of people that say, hey, I'm not stroking a check to the IRS for taxes if I don't have to. And for those people, the idea is you are going to pay the taxes on this qualified account, and you're mandated to at at RMDH. And it's just, what's the tax rate going to be and what amount is coming out? And so should we control that narrative and net the taxes out of your qualified account? And here's why, and the tax reduction and the IRMAA fee reduction, that conversation. So I think totally agree. For the folks that want to pay their taxes outside of the account, terrific. For those that don't, and there's a good bit of them, this is an analysis that may be meaningful for them.
This is great analysis for sure.
The last part I'll share with you is the fact that we will give you guidance on what's the most optimal pattern of years to convert. And what this does is, if you look just next to the years on the total tax conversion column, you can see if I did a 1-year conversion, it's 173,000 in taxes. Well, that's not the most optimal. I could actually go down into year 5 and 6 and 7, and that's where our lowest total taxes and lowest IRMAA impact would be. And for those that are saying, hey, I just want to leave the most money to the family, that total wealth generated column is going to show you at what at life expectancy, whatever, I think we put in around age 90 here, this is the amount that's going to be left to the family. And so you can easily go to what's the optimal number of years to keep taxes low and the optimal number of years to create the most wealth generated. So real easy grid, real simple grid. And the part that I also want to talk to you about is, if we introduce a bonus annuity to offset taxes or to help that break-even analysis become something that is not an issue at all, in most cases, we can go ahead and run a Roth done right report just like we normally would. We'd put in the inputs, we would get the results, and usually the break-even, like this example, the break-even happens at age 83, and beyond that, the Roth starts to accumulate more. We can go ahead and select, yes, I am using a bonus annuity in this conversation. You can put in
Wow.
a bonus amount and the return assumption for the annuity. If you want to do a little lower than the IRA, it's fine. We just did apples to apples here, but you can run this however you feel comfortable. And sometimes the cap rates and things are lower on those bonus annuities. But what it does is it adds that 20% into the Roth column and into the conversion process so that we can see that break even happen. A lot of times it's from day one. And so whether it's to offset taxes or to help in this conversation, a lot of times that bonus annuity plays in really well.
So that can help clients get over the hump of paying the mandated, I'm learning, the mandated taxes.
The mandated tax, yes.
So, and
if
you're doing a partial, so if you're doing like a 5-year partial Roth conversion or 10-year leveraging the forever clock, which, listeners, if you're not familiar with the forever clock, I'll have a YouTube video on it. But because the bonus, listeners, puts, and Tyler, I want to make sure I understand this, and this is a lot of top offices position it, you're getting this additional cash value. So now you have more cash value to put to work to help pay the mandated taxes.
Right.
And that's regardless of whether you do it in a partial or a full.
Yeah. I mean, most cases that's the trade-off, and a lot of times is that, the cap rates or different, fee assessments, and that's where you can go in and put the return assumption on the annuity at whatever you feel comfortable showing. But the idea that you're getting that bonus up front to offset the taxes or to create a better legacy look for somebody, it happens immediately. And that's I think that's why they're getting used quite a bit.
If for the partial Roth conversions, the bonus will raise the amount of overall IRA assets that you're converting, but because you have excess cash value from the bonus, you're still getting a discount on the mandated taxes, correct?
Yeah. Correct.
Yeah. Very cool. This is a great, I've listeners, I haven't actually seen this report, even though a lot of our top offices are using bonus annuities to help clients get their heads around paying mandated taxes versus optional long-term greater taxes. That's a fantastic report, Tyler. That's really great, especially in this interest rate environment.
Yeah, it's been something I think that's really it's nice. We introduced the Roth done right concept, and then if you want to share, uh, what in introducing the annuity into it and how that helps, you can do that, or you can just do a Roth with a protection annuity, or you can introduce a life policy if you want. We have the ability, when you start getting past the tax conversation and you've got the buy-in there from your clients or prospects, to introduce the product allocation, whether it's annuity or life. That becomes the next step in this, natural step in this, and that's probably the last thing I'd share with you here on the part of the process is, if you are wanting to introduce maybe both a life and annuity into the mix, you can use what we call our legacy done right. And within the legacy done right, it will share with somebody. Basically, you put in the $500,000 and it will tell you how to structure your life 5 pay and how much you should run as an illustration. And this is converting $100,000 a year. So we create that IRMAA and tax budget, and the net amount is 75,000. So think about it just in this case where this person had 1.5 million and we're doing a 5 pay into a life policy. If that gets closed, or if it's a $500,000 that goes into an annuity contract and that gets closed, these are great revenue drivers, and you're also helping the client in a tremendous way. So this tells you how to structure what life policy you should run. 5 pay, $75,000. And historically, we had to show, keep your IRA, convert to Roth, and hey, here's your 30-page life illustration that you can see what the benefit would be there. And with the legacy done right, we just incorporated into that third column. Here's the IRA. Keep doing what you're doing. This is the net dollar amounts should you die that would go to your beneficiaries. We could convert to a Roth, and here's the proceeds. It's better because it's tax-free. Or we could convert those dollars into the life policy, and the life policy will have an initial death benefit, and we're also showing any of the unconverted money over those period of years that would be added into that. And that's why the life insurance kind of reduces to what the death benefit is, because we have converted. In the early years, it's a little higher because we still have the unconverted amount of the Roth IRA. But this is terrific, and you can show something like this and show where that life approach and how it compares. It's a really easy way to intro all that.
And
Of
you could
course,
do the 5 pay or the 10 pay using an annuity, not a
yep,
SPIA or a PDA account, but a true index annuity as the funding vehicle, which I
yeah,
think you have tools to show that annuity alpha as well,
yes,
which we don't have time for today. Maybe Tyler, you'd be willing to
round two.
become a repeat guest here on IGO. Tyler, this was awesome. Before we call it, is there anything else you'd like to share with the audience today?
Yeah, I would just say, hey, this is an important conversation. It's being had. Your clients are going to hear about it. Prospects are going to hear about it. Might as well be from you. And we give you some very easy tools to introduce this into your business. We do one-on-one support to show you how to have these conversations. We're just an extension of Ben and his team, specifically around this. And those training components consist of one-on-one support, monthly study groups, and we do live events. We've got our next one coming up. It's a 2-day event in Louisville, Kentucky, February 26th and 27th, where we will take a deep dive on all of the things we've covered the last 30 minutes and make sure you feel real comfortable in introducing this into your business so you can drive more AUM and more annuity business and more life through these uh, Roth and tax conversations.
Listeners, the last thing I would add through our partnership with Stonewood and my conversations with Tyler and me saying true, as I say, proof of premium with offices all over the country leveraging Stonewood, is the differentiator is going to be there's many, but one of them is the following. You're going to get a client or a prospect from a seminar or digital client acquisition, social media, what have you, and they say, I'm good. I already have a broker. Money's growing. It's doing just fine. Is that broker talking about taxes and retirement? Is that broker talking about IRMAA? Is that broker talking about Social Security threshold taxes? More often than not, they are not. In which case, leveraging Stonewood, leveraging Tyler, leveraging the SMS platform, you can win that client. So, Tyler, thank you so much. This was very informative. We'll put a link to Stonewood in the comments section of YouTube and the website if people want to visit and explore.
It's just stonewoodfinancial.com.
Perfect. So nice and easy there, everybody. We can also set up one-on-one meetings with Tyler. So, Tyler, thanks again. I
Hey, you
really
bet.
wanted to dig into taxes, and you're the best guy I know to do so with.
Yeah,
All,
appreciate it.
all right,
Appreciate it. Thanks for
everybody.
having me. Hey, have a great holiday season to everybody. And if we could be of service, let us know.
Excellent. And so this was episode 13 of IGO. That is in good order. We covered taxes and retirement. Tyler might be a returning guest, so we can cover some other tools and strategies. Please like, listen, and subscribe. If you have another colleague in the financial services industry that you think could benefit from information like this, please forward the episode. This episode will premiere after Christmas. Full disclosure, behind the curtain. So everybody, I hope you had a fantastic Christmas. It's going to be a great 2026, and most importantly, please stay in good order.